Hello everyone, to another class for CFA Level 1. In today's class, we will be starting the fresh topic in corporate issuer, and the name of the topic is capital structure. So as you can see, we will start with capital structure. Okay. Again, this chapter is an important chapter in terms of building your base for the further topics. The chapter is again predominantly theory in nature with some practical concept here and there and couple of numericals. So having set the base, we'll start the chapter. Okay. The first thing that we need to understand is what is a capital structure. Okay. The first thing that you guys need to understand is what is a capital structure. Okay. So in order to understand the capital structure, we need to understand how a company functions. Suppose you have opened a company. Okay. Suppose you have opened a company or a firm. Okay. Now, in order to run the operations of the firm, whether it be into manufacturing, whether it is into trading, or whether it is into services, you need to pay rent. You will have to pay admin expenses. You will have to pay employee benefit expenses. Correct? In case of trading and manufacturing, you will have to also purchase raw material and you will also have other expenses. Okay. Now, you need to understand these all expenses, someone has to fund them. To fund these expenses, money is needed. Yes or no? Correct. In order to fund these expenses, money is needed. Now, where will money come from? There are primarily two sources from where money can come from. Either from own investment or you can borrow. Yes or no? In order to run the business, the money that you need, either it can come in the form of own investment or you have to borrow from someone. These are the two major things. Own investment is called as equity and borrowing is known as debt. But yes, we are into the advanced stage of financial re-engineering. So there is third kind of capital or third kind of money which are hybrid in nature, that is partial equity, partial debt. Correct? In this also, the major two forms are equity and debt. Correct? So the money that you need to run a company or run a business can either come in the form of your own investment, which is equity, or you can borrow, which is debt. This mix of equity and debt along with the hybrid if any is known as the capital structure of the business. Capital structure of business. So when you focus on the word capital structure, it is basically the structure in which funds or capital of a business is arranged. Okay. So basically, we will revise all of this again in order to understand, in order to make sure that we understand this concept completely. What is a capital structure? We have seen that in order to run a business, we can either have debt or we can have equity. When we mix both of them in a company, that mix is known as the capital structure. What is a capital structure? So basically, it is the structure in which the capital of a business is arranged. Guys, are we clear? Now you need to understand couple of things. Money is not a free resource. Correct? Money is never a free resource. We know it. So raising money involves cost. So basically, can we say every capital in the business has a cost? Guys, can we say every capital in a business has a cost? Guys, can we say every capital in a business has a cost? When every capital in a business has a cost, this is known as cost of capital. This is known as cost of capital. Now, when this capital is equity, it is called as cost of equity. When the capital is debt, it is known as cost of debt. When the capital is, for example, preference shares, and we will look into it what are preference shares. It is known as cost of preference shares. And if the company itself earned the profits and reinvest it into the business, so profits getting reinvested. When the profits are getting reinvested, it is known as cost of retained earnings. So basically what we will say is that we will say that every piece of money, every last pound of money, every last unit of money which is involved in the business, which is used in the business, has a cost associated with it. And that cost will depend upon the source from which you have got it. Whether you have got it from borrowings, whether you have bought it from previous earnings, whether you have bought it from the owners in the form of equity, or whether you have bought it from preference. Okay. So every fund invested in the business has a cost associated to it, and that cost will depend upon the source from which you have got that money. Okay. So now let us look at what is written in our power book. Cost of capital is the minimum rate of return or profit a company must earn before generating value. Now let us understand what it is saying. See, what did we see? Every capital in a business has a cost, right? This is known as cost of capital. Now, when you are doing business, okay, please listen to me, guys. When you are doing business using funds which has a cost, then the minimum return that you expect out of the business is should be enough in order to cover those costs. Guys, when you are doing a business from funds which has a cost involved, and when you are doing a business, the return that you expect from a business is that amount which should be enough in order to pay for the cost of the capital. That is why when cost of capital is defined, we also say that it is the bare minimum return that the business expects from its operation. Why? Because this return will be used to pay, or this return will be used to satisfy the provider of the funds. Let us say, for an example, let us take an example. Suppose I have $10,000. Okay. Now I have multiple options. I can invest in mutual fund. I can do an FD. I can invest in a business. I can buy shares, so on and so forth. Now, if I evaluate the various opportunities, I see that by investing the money in shares, I can earn 13%. By FD, I can earn 7%. In mutual fund, I can earn 10%. Okay. But I made a decision to invest the money in business. I made a decision to invest the money in business. So, what will happen is that when I am investing the money in business, what is the next best opportunity that I am missing? What is the next best opportunity? My next best opportunity is return from shares. So, as a person, as a layman person, we don't need to be also technically sound. This is a common sense thing. When I'm doing a business from a money, I know that I can earn at least 13% on. So, is it wrong if I expect that this business will also give me minimum 13%? Why minimum 13%? Because if the business is not capable of giving me minimum 13%, I will not do the business. I will take that money, put it in the shares and earn 13%. Okay. If the business is not capable of generating even 13%, then why am I doing the business? The funds that I have used in order to do the business, I will use that funds and put it in the share market, put it in the shares on 13%. So we can say 13% is the bare minimum we are looking on these funds. And this 13% becomes my cost of capital or cost of equity, because equity is over here, right? That is why over here it is mentioned as cost of capital is the minimum rate of return that a company must earn before generating value. Okay. The next, what are the sources of finance? So basically, when we want to run the business, what are the sources from which we can get the money? Debt. Debt is simple, it is borrowings. Then we have preference shares. A preference shares has some characteristics of debt, some characteristics of equity, so it is a hybrid instrument. Then we have equity, which is the owner's investment. And then we have retained earnings. What are retained earnings? Profits being reinvested. Guys, profits being reinvested. So, for debt, the cost is known as cost of debt. For preference, the cost is known as cost of preferences. For equity, it is known as cost of equity. And for retained earnings, it is known as cost of retained earnings. Are we clear, guys? Guys, are we clear? Guys, are we clear? Okay. A combination of all of this is known as capital structure. So when we are combining all these funds, their costs will also get combined, correct? And that combined cost is known as weighted average cost of capital. So what is written over here? Let us study. The above elements are used to ascertain the overall weighted average cost of capital. So basically, the cost to run the business as a whole based on the different types of finances it is using it is known as weighted average cost of capital. Basically, weighting all the cost of the different sources of finance. Are we clear? Let us further read. WACC is an appropriate discount rate for a project or an associate cash flow that have approximately the same level of risk as the firm's existing project. Now, what is it? Let us understand. See, you need to understand. Okay, couple of things over here. You have a business, correct? And different business will have different level of risk, correct? Suppose we denote that risk by R. Okay, based on this R, my cost of debt, which is denoted by KD, my cost of equity, which is denoted by KE, my cost of preference, which is denoted by KP, and my cost of retained earnings, which is denoted by KRE, will differ. Why? Because higher risk, higher return. So as you keep on increasing the risk, these cost of finances will also increase. But if we assume that the risk for a business is R, then for a given level of R, I can have KD, KE, KP, and KRE as my cost. Correct. Now, when I combine all of them to get a WACC, what is a WACC? A WACC is nothing but weighted average of all. So KD into debt divided by total capital or total funds. Similarly, KE into equity divided by total funds plus KP into preference divided by total funds plus KRE into retained earnings divided by total funds. Yes or no, guys? So, what is weighted average cost of capital? Weighted average cost of capital, we have known that the cost for the capital structure of a business is the weighted average cost of capital, where each type of capital or each type of finance is weighted for its proportion in the total value. Correct. Now you need to understand this WACC is for a given level of risk, that is R. Okay. The WACC that we have computed over here is for a given level of risk, that is R. Now, when you change R, when R is changing, it means your WACC will also change. Guys, you need to understand over here. See, for a given level of R, which is risk, I have computed a WACC. Now, when you change the R, your KD, KE, KP, and KRE will change, because of which your WACC will change. So, as you change the R, your WACC will also change. So, basically, are we clear till this point? Now, you need to understand how is R of a business determined. Suppose if business has 10 divisions, D1, D2, D3, all the way to 10, D10, then they will all have a different level of risk, and their risk can be written as RD1, RD2, RD3, so on and so forth. Guys, this R which we are talking about is a combined risk of all this RD1, RD2, RD3, RD4. Weighted average risk, if we can say, correct? So what we are saying, WACC is a useful cost for R, but can we say WACC is a useful cost of capital for RD1, RD2, RD3, RD10 individually? Can we say that? Will our statement be true if we are saying that WACC is the appropriate cost for risk R? Okay, that is a statement which we have seen and we have proved. But can we say WACC is a appropriate cost for business division 1 or business division 2, business division 3? Can we say that? Are we aware? Because it can happen that the risk profile of D1 is very different from the risk profile of D2, being very different from risk profile of D3, being very different from risk profile from D4, and very different from the overall company risk. Correct? So what the statement was saying is that WACC is an appropriate measure for D, okay, but WACC is also an appropriate measure for every D1, D2, D3, D4 which has a risk profile similar to D. So what did we say? We said that WACC is an appropriate measure of cost for D, okay, or for R. But WACC is also an appropriate measure of risk. WACC is also an appropriate measure of cost for every business division or project which has a risk similar to the overall company risk. So let me repeat. See what we have seen. We have seen WACC is the appropriate measure of cost for company with risk R, okay, and a weighted division of D. At the same time, WACC will also be an appropriate measure of risk for every division which has a risk similar to the company risk. Guys, are we clear what was written over here? So that is what it was written. Now let's see what we have already seen. How to compute WACC. WACC is nothing but cost of debt into weight of debt. This 1 minus tax we will see later when we will be doing the chapter. For now, ignore it. Okay. For now, ignore it. Okay. Then weight of equity into weight of preference into preference plus weight of retained earnings into cost of retained earnings. Are we clear, guys? So I hope this basic concept of capital structure and cost of capital is clear to you guys. In the next class, we will be doing further topics such as what are the factors that affect the capital structure. What we learned is that risk is one of the factors that affect the capital structure, but there are other factors as well, which we will be deep diving in details. And then we will also be solving some of the important questions on this and some of the important practical aspects of this also we will be seeing. So guys, stay tuned till the next class and happy studying.